if we were going to be able to do this in Europe, we needed another level of technology. You couldn't just take the technology you had in the US, you had to have the next level of technology to be able to unlock this. If we can create that technology to the infrastructure along that value chain, to remove a lot of those very inefficient traditional manual processes that exist, we could unlock a new asset class for institutions in Europe. The tech is the how, it's not the why or the what. Or any tech business that tries to pretend it's easy is either lying or they've figured out something I haven't, so I want to talk to them.
Samantha, welcome to the podcast.
Thank you very much for having me.
Not at all. Just saying off mic how excited I am to talk to you, because what you and your partners are doing at IMMO is like truly pioneering. And so I can't wait to unpack your journey and how you see the market and how you're going to disrupt it. But before we get onto that really good stuff, can you just rewind the clock and tell me a little bit about how and why you got into real estate?
So admittedly, I fell into real estate completely by mistake. So many people in real estate, they've got families in real estate and they've got sort of history or connections, but I really fell into it by mistake. I was doing a degree in industrial design and industrial design technology originally at Loughborough University.
What does that mean?
It means that I played sport and coloured in for 3 years, basically.
And a little bit more, surely.
Yeah, I did a bit of studying, but not so much, admittedly. But anyway, I realised I was not going to become Steve Jobs, I wasn't going to become James Dyson either. So I wasn't strong enough from a design perspective. So knew I actually needed to make some money somehow, and completely fell into an internship at Cushman's by mistake. Did a summer internship there. Was all I was looking for was an internship in an office. It could have been in any industry, any sector. So I really wasn't being fussy at the beginning. Fell into it by mistake. And actually turned out that I really loved the internship. And what was a 1-month internship, I sort of hustled my way around the business and kept extending it and introducing myself to new teams and convincing them to take me on for work experience in another team for a couple of weeks here, a couple of weeks there, and somehow got into a grad scheme the following year.
I was going to say, looking at your LinkedIn profile, you stayed there for nearly 3 years. So there must have been some good hustling to kind of string a lot of internships together.
Yeah.
So you entered into the world of real estate, and obviously as human beings, we're surrounded by real estate constantly, but whether we are conscious of it or not is another thing.
Yeah.
When did you decide, actually, I do want to consciously follow a career in the kind of the real estate world?
I think it was probably when I was doing those initial internships. It was the tangible nature of real estate. I was always interested in the more sort of the investment aspect, but I, struggled admittedly to sort of get my head around a lot of the stuff in banking because a lot of it felt very intangible. And I like to see the bricks and mortar and, really understand, be able to see, what it is that I'm working with and, and be able to relate to it and be able to see. And as you said, everyone, you're surrounded by real estate all day, every day. So I think for me, it was really the ability to touch and feel and see the impact and be able to have the potential to influence that as well was, what I found the most exciting about real estate.
So you did your real estate master's degree at Kingston Uni, while I guess you had your full-time role at Cushman's.
Yeah, so I did the grad scheme at Cushman's where they kindly sponsor you to do your master's there. Yeah.
And you did some kind of wider rotations, kicking off and getting your APC, or?
Yep, did that. Was back in the day, I think it was the finance and investment APC route. So it was, I think the first year they were running the finance and investment chartered surveyor route. I was doing that.
So more of an analytical kind of approach. And
yeah, it just meant that you're a bit more focused on sort of corporate finance, like the debt side of things as well. Yeah.
And as a kid growing up, were you particularly, or what kind of kid were you kind of growing up?
Always very inquisitive, quite creative, never really taking no for an answer. And from a pretty relatively young age, I was out sort of hustling for jobs. From about the age of 12, I was out hustling for whether it was work experience or paid jobs in all of my school holidays. I was doing that from a young age, wanting to be quite independent.
So that kind of drive kind of really fed through, and I guess hence you stringing a load of internships together and getting yourself a job at Cushman Wakefield as well at the end. Global financial crash hit 2007, 2008, just when you started. What are your recollections of that time?
Really painful, obviously, for the industry as a whole. I remember, I was on the grad scheme at Cushman's, and we would hear stories of whether it was Knight Frank down the road or, someone else making large graduate layoffs. So that was a really unsettling time for a lot of grads. But, I was fortunate enough to retain a role at Cushman's. But it was also just it wasn't sort of the most active part of the market. And I knew I wanted to be somewhere at the forefront of what was happening. So, again, completely by chance, I ended up attending a breakfast seminar at a law firm. And one of the speakers was a gentleman called Barry Gilbertson, who some people may remember. He used to be the president of the RICS many years ago, and he was also a partner at PwC, focused on the business recovery services department. And he was essentially talking about how his team was getting involved a lot with the banks, doing a lot of distress work, getting involved with companies that were in distress, either working on insolvency proceedings with them and undertaking the workout and management of their portfolios and assets, or restructuring the businesses. And it sounded like a pretty action-packed, exciting part of the market to be, where there was the most amount of work going on. And I thought it sounded like a great space for me to be able to roll my sleeves up and get to work on a very broad range of different topics as well. Introduced myself to Barry, had a coffee chat.
And one thing led to another.
Yeah, and then ended up getting a role there and staying at PwC for a few years.
So you got your letters at Cushman's, breakfast chat, one thing led to another, landed at PwC, and you were there for just shy of 3 years or so.
Yep. Can
you just recall or run through some of the projects that you specifically worked on?
So worked with some of the Irish banks, going through some of their large distressed portfolios, helping them sort of unwind various positions. Lehman Brothers was a really large insolvency that PwC managed across the whole of Europe. So there we were going in and unwinding and sort of digging into a lot of the JV agreements that Lehman's had entered into, which were interesting. Probably won't say more than that. So that was really fascinating. And then there were some other projects where we took over the sort of fixed charge receivership or insolvency proceedings on large trophy assets in central London that were sort of developments that had run out of money and were stalled halfway through. And we had to essentially take control of that development company and sort of execute a sales process of that asset. So it was a real variety of projects that I got to work on.
And did you love that variety and scope and different situations that you were kind of parachuted into?
Yeah, exactly. I've never been one to particularly deal well with being put in a box or sort of, having a very tight swim lane to be working within. So yeah, the variety was excellent. And especially at that stage in my career, to be given relatively very large sort of projects and responsibility and autonomy was great. It was very good.
You moved to Blackstone after PwC. Why and how did you make the move there?
Things were starting to slow down at PwC. And at around about that time, Blackstone had just acquired a very large NPL, non-performing loan portfolio from RBS Bank called Project Isabel at the time. And it was a large distressed debt portfolio, and they were going to have to unwind or asset manage a lot of the positions. It was the first time they bought a portfolio like that, so I knew they were going to be having to set up a team from scratch. PwC would typically see someone like that as a potential client. So I convinced my bosses at PwC to send me on secondment to Blackstone. And that was essentially like a 6-month interview at Blackstone. And they asked me to stay on at the end of it.
So it was kind of secondment into Blackstone to help advise Blackstone how to work out or set up or...
Yeah, so they were building a team. So I became one of the portfolio managers in the team, managing and working out some of the distressed debt positions that they had.
And PwC were an external advisor on it as well?
Yes, yeah.
So that's why they enabled you to jump onto the other side of the fence, as it were?
Yes.
And so you, I've had a couple of people on the podcast who've been at Blackstone, and they talk about 12 different interviews at the different stages.
Yeah, I snuck in the back door there.
You skipped it, but ended up having a 6-month interview.
Yes.
And why did you decide to stay on the kind of the principal side rather than the advisory side at that stage?
It was a lot more interesting and exciting for me as a role to then be the managers of the capital as opposed to just advising the capital. For me, but yeah, being on that management side and actually it was interesting actually, and I hadn't expected this, but I really felt that weight of responsibility that you have as a manager. When I'd been on the advisory side for so many years, to then be on the management side and realize that, I'm actually making decisions here that's, this is someone's capital. Ultimately, at the end of the day, beyond Blackstone, this is, Blackstone obviously has fiduciary duties. And it's funny because that really struck me, the weight of that responsibility, but it was something that I actually relished and, found interesting and exciting. And then just, the pace at which Blackstone worked, the standards that they set, some of the whips that they were cracking internally as well. It definitely forced me to raise my game. And I realized that this was an environment where I was going to accelerate myself. I knew Blackstone was not going to be where I wanted to stay forever. I sort of knew by that point that the corporate world was ultimately not for me. But there was a huge amount I could learn from my colleagues at Blackstone for as long as I was going to stick around.
So you worked on Project Isabella first?
Yeah, so I did a lot of distressed debt to start off with. I did that for a couple of years. And then I moved over to sort of the asset management side of the business and was there for a couple of years. And actually that was the first time that I was able to get really hands-on with assets, really figuring out what the asset management strategies should be and then project managing various teams to be able to execute those strategies. So again, not because I wanted to be an asset manager long term, but I thought I've worked for so long within the real estate industry, I should actually roll my sleeves up and get my hands dirty, on rent rolls and service charges and dealing with, residents associations or, property managers and, get more of that coalface experience, but still from, such a great establishment like Blackstone.
Did you have an idea at that stage that you wanted to own or run your own business at some stage? And was it a case of just trying to square the circle in terms of your kind of schooling before you kind of took that
a little
leap?
bit, yeah. After my first 2 years at Blackstone, I started preparing. There's a set of exams you do to get into business school called the GMAT exams. And I started studying for those. And I was actually planning to leave after the first 2 years at Blackstone. And then they offered me a role in a different team. And I thought that was actually quite good opportunity to do that for a period of time. As I said, roll my sleeves up, add some new skills to the toolkit before moving on to do something more entrepreneurial.
Can you talk to me about some of the platforms or the projects or the assets that you worked on at that stage?
I think, some of I was managing a lot of Blackstone's core plus assets. Blackstone had only just started buying core plus assets for their institutional investors. This was before Blackstone had done the Core Plus funds. They were doing this on a separate mandate basis. So I was dealing with some sort of quite some large, chunky central London offices mainly, with a bit of retail at the ground floor, mostly in the city. They were based like on Old Broad Street or London Wall, or there was one in Canary Wharf as well. There was a very large asset near Tower Hill, St Catherine Docks.
Yeah.
If you're familiar with that one. So that was really interesting because that was a sort of multi-sector asset class, and that had stabilized offices in there. It had offices that needed sort of full refurb programs and tenants to be sort of reshuffled around the buildings. It had a marina in the middle of it that needed a new management agreement put in place, and to sort of do a turnaround basis on that. It had another office building that we were doing feasibility analysis to see whether to keep it as offices or to do a residential conversion on it. I think in the end Blackstone decided to keep it as offices. And then there was a lot of residential in there as well, sort of mixed within.
So you got a really broad schooling from a kind of an asset management perspective.
Yeah, everything from actually managing tenants, managing broader stakeholders as well. So obviously not just the tenants who on your scheme, but whether it's residents associations who also are key stakeholders within your local scheme, dealing with architects, with contractors, with sort of on-site property managers. So it was really very broad. It was great.
You did end up going to do your MBA. Why did you want to do that?
I felt like I'd been in real estate for so long within a corporate environment. And I never, as I said, I never studied business in my undergrad. And I knew that I wanted to do something more entrepreneurial. But I felt at the time that I didn't necessarily have all the right business skills or acumen to know how to go about setting up a business. I think part of it was, and you don't have to have an MBA to start a business at all, but I think the benefit of it was obviously, you raise your confidence on a bunch of different topics. But also I think actually one of the biggest benefits of it was it gave me the opportunity and the headspace to think about what it was that I wanted to do next. It gave me the opportunity to explore different industries as well, meet people from such a broad range of backgrounds, both sort of from all over the world. I think at the time, London Business School, in my class, there was only about 15% were British.
Wow.
So the majority of people were international, and they were all coming from different industries. So the ability to learn from them was really humbling as well. And to, force myself to think outside the real estate bubble, that we sort of is so easy to sort of think within a bubble when you're in that real estate industry. I think it's especially within the corporate space.
That focus. And did you have aspirations to run your own business? Is that what drove you to do the MBA? But you wanted to take yourself out of real estate to give yourself the headspace, do the MBA, build your confidence, give you some skills, but also broaden your perspective in terms of what that business or what that route might look like? Or was it always a case of setting up a business within real estate, having kind of done some more kind of corporate training and equipped yourself?
I think it's a bit more the former of what you were saying. I went into the MBA with a business, like a real estate related business plan, and I was exploring it whilst I was there. But I also, the thing that really bugged me about it was that it was it didn't have a tech angle. And admittedly, at the time, I didn't really know much about technology. I just knew that this business plan would be much more of a lifestyle business than have the potential for high growth and scaling. So I sort of recognized that I want to find something that is bigger and more exciting. And it was halfway through my first year that I met an alumni of London Business School, who ended up being the founding investor into IMMO. I was sort of exploring a number of different topics around the real estate space at the time. At that moment, there was institutional investors were starting to invest in residential in the UK, but it was very nascent. And I remember back then reading reports from the BPF, and the biggest challenge institutional investors were having was identifying and being able to acquire institutional products. They just couldn't. The supply of residential that they could get their hands on just wasn't there.
It's too granular, scattered. What retail investors had.
Yeah,
smaller portfolios.
They weren't even necessarily looking at that end of the market. They were looking for more kind of big blocks, big institutional blocks. So anything above typically 50 million plus. There's also a lot of investors that won't get out of bed for anything more like less than 200 million deal size. So they were just really struggling to find these big tickets that they could deploy capital into. And I remembered when I was at Blackstone, so post GFC, Blackstone in the US, they set up a business called Invitation Homes. And that was where they were acquiring individual existing houses, single family houses. And their original thesis was they were buying so cheap, they were buying so far below replacement cost, they would just hold them and they were just going to flip them when the market came back. That was the original thesis. What they quickly realized was actually, whilst they were renting them out in the meantime, they realized actually with scale and with a bit of technology, it's not actually that hard to manage dispersed, granular homes. And actually they realized they were creating incredibly stable, sticky income streams that were perfectly matched to what pension funds and insurance funds want. So instead of buying to just flip them on, they realized actually let's buy, hold, scale this up, create these incredible, stabilized, large-scale portfolios, and then you've got the perfect product for the pension fund and insurance fund world.
I guess the challenge there, or the key point of difference probably, is the technology piece, is to enable you to do it on scale, because they're so granular. As you said, some investors won't get out of bed unless the check's 200 million. Here it's 100, 200.
Yeah, so it's historically, and it's a very inefficient value chain when you're using traditional manual processes. Of course it is, which is why institutions have never looked at it before, and that's, Blackstone stumbled upon this, really, if they're honest about it, but then realized there was a really fantastic asset class in there. And as with many things Blackstone do, other people follow. They're always often the leader in these new ventures. And I think between 2020 and 2021 in the US, there was about $60 billion of institutional capital went into that granular existing end of the market from institutional capital. So it's become its own sector in its own right in the US. You've got SFR REITs, SFR securitizations. So it's very established. But when I was over here, I saw that there was this real disconnect between the demand from the capital and the institutional supply, and recognized that if there was a way to be able to aggregate and scale up these existing portfolios, dispersed portfolios for institutions, you could unlock this asset class for the capital investors. And the reality is, it is the largest asset class in the world. The European resi market is like over $40 trillion. It's even larger than the US. And about 95% of it is sort of granular stock. It looks a bit different across Europe. On the continent, there's a lot more multifamily. But even then, small multifamily is typically sort of anywhere from 5 to 10 to 20 million euro lot sizes. So still individual lot sizes that institutions do not want to go around piecing together one by one. And then in the UK, it's a lot of individual, it's smaller multifamily as well, similar to the continent, but actually the majority of our residential stock in the UK is individual houses. Our housing stock is just slightly different over here in the UK. But the opportunity is huge across the whole of Europe. So we realised that if we can create that technology to the infrastructure along that value chain to remove a lot of those very inefficient traditional manual processes that exist, we could unlock a new asset class for institutions in Europe in a similar way that it was done in the US.
So kind of taking that blueprint, applying it to the UK and European market over here.
Yeah.
So you took that thesis. How did you take that and turn it into a reality?
Well, so we knew, there's a reason the big US SFR players haven't just jumped across the pond and like copy pasted the model over here. The reason being is that, and this isn't just about residential, there's a lot of business plans that work well in the US, but they don't just translate over to Europe. And the big challenge for Europe is just the fragmentation of Europe as a continent with all the different countries, different languages, legal systems, regulatory systems. It's just much more fragmented. You have to sort of essentially build mini companies for every single country. And then also our housing stock isn't as homogenous as it is in the US. So we knew that if we were going to be able to do this in Europe, we needed another level of technology. You couldn't just take the technology you had in the US. You had to have the next level of technology to be able to unlock this. So as I mentioned, when I was at the MBA, I met someone who ended up being our founding investor. He also brought with him VC seed funding for our business idea. I met my co-founder, Gigi Zappel, who's also our CEO. And we set up the business then. So we had the seed funding from the VCs. We also had some angel investment. And we set about to build the business. We knew that we needed capital, real estate capital, to acquire the assets. That was not going to come from institutions day one, sadly, and we sadly didn't have sort of the Blackstone name behind us. So we started raising capital from family offices. It was pretty hard to raise the capital in the UK. So actually we had success though raising family office capital in Germany. So that's where we started our operations in Hamburg. And started deploying the family office capital there, started scaling that up, using that as, to really build a lot of the technology and processes around it. Made a lot of mistakes on the processes, had to scrap technology, rebuild technology. But we did that and, learned a lot about how to set up the operations on the ground. Because obviously, as with any real estate operating business, technology only gets you so far. You still need people to run a lot of processes. And then once we started getting the track record, the stabilized operational track record, we were then able to raise a commitment from Naveen, and we started deploying that capital, and that was our first institutional clients. And operationally, that's gone really well. We've sort of outperformed all of our KPIs on that. The team have done a really fantastic job there.
How did you go about identifying family offices? Because there's a lot of businesses that have spun out and set up in the last 18 months or so that are looking to raise capital, and family offices is an obvious pot to go and try and fish from. The challenge is identifying them, right? How did you circumnavigate that?
Yeah, it's not easy. It was a bit friends and family offices, as in like friends of friends type of
network effect to be able to introduce and connect you to those groups.
Yeah, we did. Admittedly, we've tried to do in the past as well a lot of capital raising with family offices, just kind of with a bit more of a kind of a blanket approach to going and pitching to lots of family offices, and they're a pretty hard market to unlock. If I'm honest, if you have a warm lead into a family office, then you're going to get a lot further. But just
turning up and pitching an idea,
it's pretty hard. It is pretty hard.
So you raised friends and family or real estate capital for the real estate deals, and then you raised venture capital, VC money specifically to build the tech.
Yes,
and you met your co-founder at London Business School as well.
He wasn't at London Business School, but just through the network.
Through the network there. How did you divide your roles between the two of you?
So he doesn't come from a real estate background. Originally was at Morgan Stanley, so he came from banking, and then he was in a hedge fund, and then he actually had set up a retail tech business before IMMO. So he already had more of the sort of entrepreneurial startup experience. And yeah, I was the real estate person. So it was sort of quite clear, sort of the divide. The more sort of technology, corporate, venture capital raising part is more with my co-founder, and then the real estate, sort of all things real estate, were sitting with me.
How you mentioned earlier in our conversation, you can't just apply the technology in the US over to the UK and European market. It had to be that plus more. Where did AI fit into that kind of tech stack plus more? Was that quite an early play, or were you working with large language models that now know as
not really, AI? If I'm honest? I mean, we now do a lot with AI, and we have we were selected for like special sort of startup grants from OpenAI, and we get sort of early access to their new LLMs and stuff like that, which is great. And we have some really fantastic AI experts within the business. But yeah, it's really it's accelerated the past sort of 2 years or so, and it's really unlocked new potentials. I think unless you were going to be, a pure AI focused business, there's still so much for us to do in terms of just like, forget AI, just even breaking down all the very traditional processes that exist within real estate, being able to break them all down, document them, understand how you should put them back together in a smarter way, and then how to be able to then digitize a lot of those processes. There's a huge amount of work just around that to start off with.
Give me a couple of examples then in terms of that kind of chain and specific things that need to get broken and then re-put back together.
Yeah, it's just things like even, our sourcing processes, how we source deals and how we then screen them and how we underwrite them. Often you might just have one person sort of doing the whole lot. They source their own deals, they identify whether they want to proceed with them or not, and then they underwrite them. Whereas because what we do is we target high volume of leads. You can't have someone just doing, the whole thing. We have a specialist sourcing team. We have a specialist underwriting team. We have also people very focused on the transaction management processes, and really understanding how you break those all down and where the handoffs are between each person. But then also, really importantly, what is the data that you're trying to capture at each of those stages and each of those steps to be able to pass the information down the chain, and then what is that infrastructure that's allowing you to pass that information down the chain. So, for example, the technology the way we source assets, we have a number of different sourcing channels that slightly different depending on country. But for example, in the UK, because we're sourcing a lot of houses as well, we've got APIs into all of the Zooplas, the Rightmoves, all of those listing platforms. So we get, essentially dumps of all of those leads every single night, which is thousands of new leads coming through the system every single night. We then have other sourcing channels, like we have broker relationships as well, who will send us portfolios of residential, or they will send us, maybe portfolios of small multifamily, or maybe just individual multifamily. So we need a process for bringing those into the top of the funnel as well. We also have connections into housing associations and local authorities, where we might get different type of information being sent to us. There's not a glossy marketing brochure. It might just be a rent roll or an Excel sheet that they send us. But all of those different channels, they all come into the top of the funnel, you've got to imagine. And the technology is able to then start filtering through those leads. So what we have done with AI over the past year is we've been able to develop our own internal tool called NOx, which stands for knowledge extraction. and the AI is able to identify the data that we need, the information that we need from all of these different formats, whether it's a rent roll in an Excel, whether it's a PDF marketing brochure, whether it's an email, whether it's the Zoopla listing, whether it's an EPC certificate, whatever the information is, the AI is essentially able to grab all of that unstructured data and structure it into the correct format that we then need, that can then be filtered, and we can do an initial high-level filtering for whatever our, buy box is, and then it can auto-populate the underwrite models that we've developed, so it can do the initial high-level underwrite on it in an automated way, and then we can have a very quick upfront estimate of what is the IRR on this deal, or what is the cash on cash, or does it match one of our capital partners' buy boxes. So essentially, of all those thousands of leads we get every single week, which ones should we be shortlisting and focusing our attentions on? And then it can, continue through the acquisition funnel.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People, Property, Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. Just imagining someone like listening to this who is going through a process of like trying to manage a team of analysts and a team of investment individuals and all the different relationships that they have in their network to try and manually through spreadsheets underwrite this quantum of deals and this data and this information. Yeah. And you're saying you've built some technology that basically takes it all in whatever format it comes, synthesizes it, processes it, and gives you some very accurate information very, very quickly, and then buckets them into particular return hurdles or maps it to LPs. Yeah,
so we're able to kind of automate that upfront, essentially creating the initial pipeline. We're able to automate that relatively well. Obviously, if there's a more complex portfolio coming in, and Germany, as an example, is a lot more complex than the UK. We've been able to, automate a lot of the rent control calculations and things like that. So that's not the issue. But, for example, there will be, in Germany, it's much more common to get large portfolios where, there's more value add initiatives that you have to do on the assets to get your returns in Germany as well. You've really got to roll your sleeves up in Germany. Whether it's you've got to do your EPC works to it. You've got to add another floor on top to create new space. Maybe you've then got to do an attic conversion. Maybe you add balconies. Maybe there's a one floor of offices above the retail that you can actually convert into residential. Maybe there's a large plot at the back that you can potentially carve out and get planning permission on that and sell that off separately to a developer. So Germany is more complex, but we can still use the tool for the more the smaller multifamily deals that we get through, like I was saying, the 5 to 20 million individual multifamily blocks that maybe aren't part of such complex portfolios. But yeah, it's taken, even so, as I said, there's still a bunch of different value add asset management initiatives that you can do on these individual multifamily blocks to get your returns. So it has taken a huge amount of effort to be able to create a process and a system to be able to identify which assets are worth us spending time on and focusing. And then there will be more manual efforts at a later stage of the funnel.
Yeah.
But if you imagine that underwrite model that sits within our system, it's not a black box. It can all be output as Excel so that our capital partners can, it's fully auditable by them. So, for us, the trust was really important for them to be able to understand how we were underwriting these deals, and there was no, black box AI magic making decisions or doing anything funky within the system. Everything can come out and be checked and audited and, stored on, file for governance purposes and all of those sorts of things. But it was, that model can continue to be enriched within the system as we continue going through our due diligence stages. So, for example, we also, the team have built an amazing CapEx calculator that, has been signed off by people like CBRE and Drazen Summer, and they've all said, they've been trying to do something similar like that for 10 years. So, the team have done a really excellent job in building this calculator that can essentially take all the different potential variables of what the retrofit program could look like for a multifamily or single family home, and to take it to an EPC C versus an EPC B versus an EPC A. What are the different costs that would need to be undertaken to get to those different levels, and then we can also see what would be the ROI on each of those different steps, and be able to agree with our capital partners which EPC level are we aiming for on those. And then also the team have also recently they've built a feature within that CapEx calculator where we can also calculate what is the embodied carbon associated with that retrofit, so that our investors, our partners, they know that if they're going to put 200 million of equity to work in this strategy, it will be responsible for X amounts of embodied carbon, versus if they put that same 200 million of capital into a new build program, they can benchmark it to see actually this retrofit is far more efficient from an embodied carbon perspective. Just as an example of like some of the other metrics that the tool is able to calculate for the institutions. Maybe one other area that the AI is quite interesting as well. What I mentioned was NOx. It's extracting data and information. It then gets used further in the transaction management process or in the due diligence process, where you imagine, you get a data room of documents sent to you when you get to a certain stage of the deal, and we can drag and drop those documents into our system. Takes a few minutes, but the system will ingest those all, rename, file them all, and be able to extract the right information to be able to pre-populate our due diligence checklists. So, we've come up with a whole host of different questions, due diligence questions, that the AI is screening the information for, and it's able to identify, for example, has flood risk been identified? Is there monument protection within any of these assets? Are there any inconsistencies within the square meterage of some of these properties? Is there a reason why, it's highlighting there's 3 different documents that have 3 different, 3 different areas listed for the same building, and then it will give you a link to then go and check. And, and a person still needs to then go and check those 3 documents. They're like, oh, okay, that's why. Like, there was an extension or something done later, and it wasn't clear in the documents. So actually, we're going to take document C as the correct square meterage. So it's speeding up a lot of due diligence checks that that otherwise would have taken a very, very long time for a whole bunch of different analysts to be able to do manually on their own. It's not making any decisions off the back of it, but it's just streamlining a lot of processes.
So it enables you to get to the punch much faster. So
Correct.
if someone puts a deal to you, you can turn around whether you want it or you don't, and what price you're willing to pay, and your wider business plan in terms of how you're going to deliver it and for which investor, much faster than someone else who doesn't have the technology.
Correct.
And so do you see yourself as a prop tech company, or are you a real estate company leveraging tech and AI?
It's a really good question. It's like the question of, is Amazon a retailer or a tech company? Are they a retail company or a tech company? You could say that they are a retail company that's built on technology, or you could say they're a technology company operating within the retail space. So yeah, I think it's you can see it both ways. I think what is really important for us, though, is that we have the real estate expertise in-house, because if you don't have the real estate expertise in-house, then you can't build the processes to the standards that you need to. And especially when what we're doing is as the operating partner, we are managing other people's capital. You know, I mentioned when I was Blackstone, like there is a huge level of responsibility that comes with that, and a huge amount of trust that we have to gain from our capital partners to allow us to manage their capital. So it's essential that we have that strong real estate foundation within the business. But then, yeah, we have a lot of sort of technology experts as well, sort of building the platform to enable those real estate experts to be more accurate and faster in what they do.
Is the plan to license the technology that you've built, or to keep it proprietary and have that as your own USP and edge and angle?
Yeah, it's a really good question, because a lot of people ask us that question. At the moment, the intention is to keep it in-house and proprietary. And that's not because we're trying to be all secretive about it and, you know, keep it just for ourselves. It's a business model question. Building a SaaS business is completely different to building an operating business. You know, to build a SaaS business, you know, you need to look at your UX, for example, in a completely different way. You then need to have a completely different sales, you know, you need to have a very different sales team to like the capital raising team. You know, the KPIs and the metrics that you're focused on as a business will be completely different. So I think whilst we are still building the business and building this operating platform, that has to be our absolute focus. And we can't risk having, you know, potential conflicts internally. We know who our customer is. So technology, their customer today is the internal operating people. And as a business, our external customers are, you know, real estate institutional partners. If we start building a SaaS business, you know, our internal operations team are no longer the primary customer for our tech team. So, and it's not to say that that's a bad thing, but that can happen when we get to a certain scale. It's a distraction that we don't need today.
Can you talk to me about raising institutional capital in this environment, because it's really tough?
It's
understatement. It's really, really tough.
It's really tough.
And how has institutional capital responded to the business that you are building, which is obviously underpinned and driven by technology?
Yeah, it's really interesting. So, I mean, the past 2 years have been awful, not just for us, but everyone, right? Everyone has struggled to raise capital. Even Blackstone are, you know, struggling to raise their funds. So, you know, it's been really difficult for everyone. I think, I mean, the good thing about, you know, whether it's off the back of COVID and, you know, everything that's happening over the past few years, is that there is so much institutional demand for residential, and that's only increasing. So the tailwinds supporting what we're doing have never been stronger. So from that perspective, it's great. We have a really fantastic, you know, bench of capital partners wanting to work with us, but understandably, institutional investors to sign JVs and to work with new platforms and operating partners, they want to see the first seed. They want to have a seed portfolio that they can work with together. And the transaction market's obviously not really been there to support that. So from that perspective, it's been hard. But I think the very good news is that we've worked really hard over the past 2 years to continue to institutionalize ourselves and our processes, continue to outperform on the portfolios that we are currently operating, and also to, you know, strengthen our real estate expertise in-house and continue to develop the technology to the point where now we do have a lot of institutions wanting to work with us, because they recognize that they just can't find the institutional supply. Obviously, a lot of people have been focused on new builds over the past 2 years, new build residential, because the developers, whether they've been in distress or semi-distress, or they originally built to sell and they can't sell to owner-occupiers, so they've been turning to the institutional market to sell. So a lot of transactions that have happened have been within that new build space. But even that hasn't delivered the supply that the institutional market needs for the amount of capital that is allocated towards it. Plus the fact that was a window of new build supply coming to the market because of, as I mentioned, about just the sort of distress, semi-distress with developers. And institutional investors know that as a window. They know that window is closing probably next year. But they still have huge volumes of residential that they need to be deploying. And the next area they're going to be looking at is acquiring existing stock. And there's some institutions, they want to acquire the finished product. And what I mean by that is the aggregated, stabilized portfolios already. Yeah, the core stuff. They want that portfolio to be manufactured for them already. But lots of the institutions that we work with are either they're really long-term holders of this stuff, so they're happy to take that aggregation risk and then continue to hold it, or they're more the players, the value-add players who are looking to be the ones to basically do what Blackstone was doing, where they take that aggregation risk and look to create those institutional portfolios, acquire undermanaged stock, where they're not having to compete with other institutions today because it hasn't been institutionalized as a market. They're buying really far below replacement cost with the existing stock. And then we do the retrofits, we institutionalize it, stabilize it, and then they've got a nice core, safe, stable portfolio at the end of it that is sort of perfectly matched to a core investor.
That they can either recap or they can kind of exit to someone else.
Yeah.
Can you talk to me about how you've gone about building your team?
So a lot of learnings on that front. At the beginning of our journey, we were, I think, admittedly, we didn't hire enough real estate people. But then as I was mentioning earlier, building that real estate credibility and expertise is so essential for gaining the trust of essentially the people we're trying to make our clients and customers. So that's been a big learning, and we've really doubled down on sort of strengthening our real estate expertise over recent years. And because we realized also that matters so much to the investors. The tech it's the how. It's not the why or the what's that we're doing. The technology is the how we can do what we can do. It's not the whole business. So, that's also shaped a lot of how we pitch to people and things like that. So we focus a lot less on the technology than we used to, because there's some people who just get completely overwhelmed as soon as you start talking about technology. But also ultimately, investors, they don't really care too much about the technology, the underlying. Like, they like to know about it, and some like to know more about it than others because it's interesting and it
point of difference, it's a USP,
exactly,
it's an edge or an
exactly.
angle. But they want to deal with you as an operating partner because you're real estate specialists.
Exactly.
Rather than
can they trust us to make the right decisions, acquire the right assets, make the right investment decisions, underwrite with the right levels of credibility and accuracy and transparency, and then can we manage the portfolio in a responsible way? Will we be able to do all of the asset management reporting on a timely fashion with the right, transparency on all the different data points in a timely manner, all of those sorts of things. So that's ultimately what they really care about. The technology enables us to do that, but they
don't care about how you're able to do that. They just want to see their report or their update and be confident that you guys have got it.
Exactly. So the real estate piece is really, really essential for us. And I think I mentioned earlier, when we're building these real estate processes, you need real estate experts to guide and work hand in hand with our product and tech people to be able to do that. And it is a very different way of working. So our real estate experts, they have two hats, really. They have the traditional real estate hats, and then they have another hat where they have to work hand in hand with technology and product to continue building and improving not just the technology, but also the processes. So they have to also be the ones to challenge how they've historically worked and challenge all of their, legacy views and biases over how the real estate industry operates. And sometimes there's very good reason the way the real estate industry operates, but then there's also a lot of inefficiencies in there and a lot of unnecessary ways of working, and that's quite hard for people to step out of that industry and think in a very different way. So that's actually been one of the hardest things for us when we're hiring a team and we've been building the teams, is finding the people who have enough real estate expertise to be the experts, but aren't so institutionalized that they can't be open to adapting and thinking about how to do things differently, and then able to, communicate and work with the tech and product teams, because you've got to imagine it's like two different worlds trying to come together. Two different languages. Just even something as basic as on the investment side, we would keep talking about the investment product, and the tech and product teams were like, product? What are you talking about? Like product is tech. Like just even some really basic,
nuanced
terminology.
Like talking about real estate product as like the actual asset that your customers, or residents will like live in, right?
Yeah, but then they were like, "But you talking about the physical?" But then there was also the physical product. Well, there's the investment product, like what are you selling? Is it, your strategy? The investment strategy is also the product. There's just a lot of, and I think in the real estate industry, we're very guilty of having a lot of acronyms. And actually, any industry, you have acronyms and a whole different sort of language that you communicate in, and that's very hard for people from the tech world to unpick that. So that's been a big challenge. Yeah, it's been a huge challenge. Yeah, it's a huge challenge. Continues to be a huge challenge. I think any business or any tech business that tries to pretend it's easy is either lying or they've figured out something I haven't, so I want to talk to them.
And I guess the residential space is quite a nascent market as well, right? In terms of, what Granger is probably like the largest, most institutional grade single family landlord.
You've got the build to rent space coming through, sort of the more heavily amenitized space. But again, that's new within the UK. You've got more people moving into single family, but that is often within the new build, because that's sort of the easier transition for them to make. But the opportunity and the volume and the returns really are in the existing residential space, because that is everywhere.
It's like the reposition to rent.
Yes. I mean, it's everywhere. And there's already a very established PRS market within the UK, that, the mum and pop type of landlords, who a lot of them are exiting the market at the moment. Government has not made it easy for the mum and pop landlords to be operating in this country. The types of regulation that are being brought in to protect renters, great, but it's clearly geared towards a more professional sector and a more institutional sector. It's really, the mum and pop landlords are being squeezed out. A lot of them are exiting stock, and there's a lot of opportunity for institutions to be stepping into this space, acquiring existing stock in locations where there is no chance of getting new build supply in these areas.
Because of planning?
There's just no land. There's no land in a lot of these areas. You imagine sort of your typical CBD town centre, city centre, and then you've typically got a ring of Victorian terraced houses around it, don't you? That's pretty established, pretty deep, and then maybe further out, and then you got sort of your established suburbs, and then further out you might find some plots that you can do your new build schemes on, but they're not established, sort of really urban areas. Typically, obviously you get the odd scheme that comes available in these areas, but again, nowhere near the volume that the institutional markets would like. So yeah, the ability to buy in established areas, established neighborhoods that you can't get any new builds supply into, and you're buying below replacement cost in these areas, and your stock by the time you've renovated it is really, sort of best in class in this area. So it's really in high demand. It's a fantastic opportunity for institutional investors, but then it also really benefits the renters as well, because the quality of our housing stock in the UK is terrible. It's really terrible. The DLUC, the Department of Housing, Levelling Up and Communities and Housing, they did a white paper a year or so, a couple of years ago maybe, that said about 25% of our PRS stock in the UK was substandard, and 12% of our PRS stock in the UK is a Category 1 hazard, which means that it's not even fit for human habitation, which is a shocking... I think those statistics are absolutely shocking and outrageous for the UK to have those type of stats. And, the Category 1 hazard, those examples are where you get the really sad situations where that little boy died of mold inhalation a couple of years ago. And that just shouldn't exist within our country. So I think, for institutions to also, they can have a huge social impact if they step into the existing residential space and upgrade the housing stock. And then obviously there's the benefit of retrofitting assets, and that we're helping decarbonise our housing stock, which is the largest contributor to carbon emissions in the country. And I can't see consumers or buy-to-let landlords taking up the mantle to, turn all their properties around to a minimum of EPCC within the coming years. It really needs, institutional capital can have a very material environmental and social impact on our housing stock in this country.
As you go about refurbing these properties, could you walk into one of them and tell it's like an IMMO home? Is it like, have you standardised all the processes down to how you go about refurbing the kitchen, the bathrooms, the bedrooms, the paint you use, or like the way that you kit it out? How is there a kind of economies of scale that you can access?
Yeah, so we've our development team have developed what they call the Yellow Book, which is essentially like a hotel. Imagine like a hotel, they have a hotel standards guide, don't they? So we have our Yellow Book that covers 2 or 3 different standards, depending on the particular sub-market that we're operating in. But yes, it's generally we aim to standardise as much as possible. There might be some nuances around some of the standards, whether it's like kitchen countertops. They might have slight differences between the standards, but as much as possible, we aim to standardise. But it's not. We haven't created a branded product where it's, like a WeWork, like it's a WeWork property in your face. Yeah. Because we want to create homes that are a bit of a blank canvas for people to make their homes. And not, we want them to feel that they're living in an IMMO home because it's high quality, it's standardized, they know what they're getting. And, there's also a customer service wrapper around it that, they feel, they feel very safe, secure, and that the whole process has just been easy for them, easy and transparent for them. But we don't want them to feel that they're living in an IMMO home, that it's our branding. We want people to create their own homes.
What does 2025 and on look like for you and the business?
Well, fortunately, not just for us, but the whole market, I think we're, I think the consensus is that, the light is definitely there at the end of the tunnel. I think the market has been coming back since the end of the summer. The door has started opening. It hasn't flung wide open yet. But yeah, that door will gradually open more and more, I think, going into next year. So we've got a lot of capital partners lined up, looking at deals with us, like getting deals ready for next year. So hopefully in the UK and Germany, we're going to be scaling up our deployments quite significantly with our capital partners.
For someone who's set up and run your own business for the last 7+ years, what advice would you give to those who are just starting out on that journey now?
I think a good dose of resilience coupled with naivety is not a bad thing. I think if you really knew how hard it was to set up and run a business, I think you'd probably run a mile. So it's probably good we didn't know how difficult it would be. But then at the same time, it's really exciting. It's really exciting, and it's a great opportunity, and I love what we do. So I wouldn't change it in any way. I think specific to real estate, I think what I often see in prop techs is they don't have enough, and like I said, it's the mistake we maybe made very early on in our journey. We didn't have enough real estate experts in-house, because I think you really need to figure out how to bridge that gap to your customers. And if you don't have the real estate experts in-house that allow you to create that bridge and to translate what it is that you're doing, you're just going to be met with resistance or people not really knowing. They're like, oh, this sounds great, but we're not really sure how to engage with it or bring it into the business. Another, I think, big piece of advice, it would be to be very prudent with runway and cash flow. And the reason I say that is because if you're prop tech that's selling to the institutional markets, one thing that is very frustrating within selling to institutions is the sales cycle. The sales cycle can be anywhere from 9 months to 2 years. That is not normal. A startup does not typically have the luxury of having 9 to 24 month sales cycles. So I would say, and you need to make sure that when you're planning your business and planning your cash flow and your runway, you are accounting, if you are selling towards the institutional world, you are accounting for the fact that you can end up having very long sales cycles. Do not think you're going to go pitch to someone and you're going to sell them your product within 2 months. It's highly unlikely. Maybe you luck out, but it's unlikely. So
yeah, don't go broke, don't go run out of money. Keep an eye on your cash flow. As we draw to a close, Samantha, a question I ask everyone who comes on the podcast is: if I gave you £500 million of the capital, who are the people, what property, and which place would you look to allocate that capital?
Easy answer. IMMO. Yeah. So I mean, I think if we're focused on, UK and Germany for different reasons. I think Germany, there is an opportunity to get in and acquire assets between that 5 and 20 million lot size mark that typically institutions haven't been accessing before. And there's been a lot of capital that has wanted to enter the German market and previously hadn't been able to because they were feeling priced out of the larger deals where there is more established institutional market there. So I think, targeting that smaller lot size, there's a real opportunity to sort of make your value add returns. You need to roll your sleeves up on them, but there's sort of a finite set of different asset management strategies to go through, and you can be quite formulaic about how you figure out which are the right strategies to be applying. So I think that's a great opportunity. And then the UK market, obviously, I think it's a relatively nascent residential market. There's just so much capital chasing residential in the UK at the moment as well. That new build window is closing, and I can just see from the institutional investor, the conversations that we have, that people are really crying out for stabilized, sort of high quality residential. So for people to step in and take that step of aggregating, take the risk and the opportunity and the returns that come with it of aggregating, retrofitting, and institutionalizing these portfolios for investors. I think there's and being able to do that far below replacement cost, sort of about 20% below replacement cost, is, it's a no-brainer. It's a no-brainer to me.
Well, look, you've got a fascinating background story, and you're a proper pioneer in the space. So I've learned a bucket load today, and I know a lot of people listening to this will be inspired and will have a lot of food for thought in terms of how they kind of maybe implement some of the ideas that you've kind of that you apply in your business to their business. So thank you for being so open and sharing, and I'm really excited to see what you and the team go on to achieve 2025 and beyond.
Well, thank you for having me.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you next time.